Good morning, restaurant owners, and welcome to this week's live Facebook training. My name is Tim Cernett. I'm a CPA and I own the firm Financial Optics. We provide accounting, advisory, and controllership services to independently owned restaurants. We do this weekly live Facebook training just to impart to you some of the experiences that we have with our clients and how we help them improve profits and cash flow. So let's move on to this week's topic. And let me share my screen. And that should be it. And this week's topic is restaurant tax strategies that keep more money in your pocket. How the One Big Beautiful Bill Act and key provisions for restaurant owners can help you save on your taxes and keep more money in your pocket. The purpose of this next 15 or 20 minutes is to increase your awareness of what's out there, what opportunities are out there for you as an independent restaurant owner, and to take some of these ideas. This is the perfect time of year. The year's almost over. Are there any opportunities for year-end tax planning or to implement some of these strategies at the beginning of next year to take advantage of them for an entire year? So take some screenshots, take some of these strategies to your tax advisor and see if there are any changes that you could make to reduce your tax burden and put more money in your pocket. Okay, so every dollar saved in taxes is a dollar for your business. It's a reduction. It's an increase in your bottom line cash flow. So the hard truth is most restaurant owners overpay in taxes every year. You're not taking advantage of all the opportunities that are there within the Internal Revenue Code. And our promise is over the next 15 minutes, you will most likely discover some effective tax strategies that could reduce your tax bill. And again, the idea for you is to increase your awareness, stop the video, take some screenshots, bring these ideas to your tax advisor so that you can start to save some money on your taxes. So there's some common costly tax mistakes that restaurant owners make. Number one is blurring personal and business expenses. Using personal accounts for business expenses creates accounting headaches. And if you're ever audited, kind of makes the IRS look at your records a little cross-eyed and wonder if they should dig a little deeper into some of your personal expenses. When you do use personal accounts for business expense, create expense reports and just reimburse yourself for those expenses. Make it a true audit trail that you've created an expense report. These are the things that I've incurred on my personal accounts, and the business is reimbursing me for those expenses, just like any other employee. Number two is poor real-time expense tracking. Failing to document deductible costs as they occur leads to forgotten expenses or weak documentation. Overlooking major tax credits, number three. There's some industry-specific credits like the work opportunity tax credit or the tip tax credit, often go unclaimed. These are really valuable tools to take advantage of. Those tax credits are a dollar for dollar reduction in what you pay the IRS. It doesn't just reduce your taxable income, it reduces the actual tax dollar for dollar that you pay the IRS. So make sure you're taking advantage of those where appropriate. Unplanned asset purchases. By assets, we mean major restaurant equipment, major improvements to the interior of your restaurant. So it's buying equipment without a depreciation strategy. We're going to talk about some of those depreciation rules here in the next couple minutes. But if they're not included as part of the discussion with your tax advisor, you might be missing opportunities for timing on some very large immediate write-offs. Also, treating taxes as just an annual event, waiting until tax season to provide all the information to your tax preparer. They prepare a tax return. Here it is, you sign it, we'll file it, and that's the end of your tax involvement or your tax planning. There should be more in-depth planning, more discussions with your tax advisor throughout the year. Every quarter is what we suggest, so that you're implementing things at the proper time, at the right timing to take the best advantage of some of these opportunities. Core strategies to reduce your tax burden. Maximize deductions through proper categorization. And that's just having a good accounting and bookkeeping system in place so that you're capturing all those expenses, making notes on what it is and why it's a business expense. And then we already talked about maintaining separate business accounts to reimburse and then reimburse yourself for personal payments through an actual documented expense report. And then tracking business mileage, that can sometimes turn into a good sized deduction. Mileage that you put on your personal cars for catering, supply runs, banking, anything that you do outside the restaurant that is a part of your business life. Distinguish between ordinary expenses and capital assets. We're going to get into that a little bit more. And part of that is number two, optimizing those depreciation and capital expenditures, taking advantage of what's called Section 179 and bonus depreciation for equipment, point of sale systems, any other major asset purchases, so that you're timing those purchases correctly to align with cash flow and tax your advantages. Number three is claim all those available tax credits, the work opportunity tax credit for hiring from targeted groups. It requires some documentation there, but you want to make sure that you're understanding where those opportunities are. And sometimes you might be hiring from those targeted groups and not even taking advantage of the tax credit that's available for you there. Energy efficient credits for lighting and HVAC upgrades. And then the FICA tip credit for taxes paid on reported tips. That's a big one, especially if you're in a reduced minimum wage and tips state. Optimizing entity structure, number four, S Corp, LLC, C Corp, which is the one that's the best fit for you to minimize self-employment taxes and balance owner salary versus distributions to reduce payroll taxes. That's something that could be a long discussion with your tax advisor, but something to consider. Implement owner fringe benefits, establish tax advantage health insurance, retirement plans, accountable reimbursement systems. Those are things that we're not going to really get into the details here. And it also goes hand in hand with choosing the right entity structure to take advantage of some of these fringe benefits that are available out there. And again, that's a discussion that needs to be happening with your tax advisor. This is a good time of year to bring some of those things to your tax advisor. They're not busy with the actual tax season. They just finished up the extension tax season. So they would have time and probably welcome those discussions now in early January so that you're aware of any year-end moves you should be making, and then what moves maybe to make in early 2026 to take advantage of those opportunities moving forward. Okay, here are some things that have changed with the One Big Beautiful Bill Act. Permanent 100% bonus depreciation. So what changed here is you can now write off the entire cost of eligible equipment in the year of purchase versus accelerated write-off on just a portion of the cost. There are no more multi-year depreciation phase outs. Section 179 expensing limit has increased to 2.5 million. For most of our independent restaurant owners, that's not a big deal. If you're spending 2.5 million in new equipment, you're a bigger, probably not so independent restaurant owner. You're a big restaurant group. And then the phase out of threshold now starts at 4 million on some of these write-offs. Why it matters is this accelerates deductions on kitchen equipment, renovations to your restaurant, and technology upgrades, freeing up immediate cash flow for growth and debt reduction. So a $50,000 kitchen upgrade could now generate $10,500 in tax savings in 1 year, assuming a 21% tax rate. So again, there's timing there on when you, especially here at year end, if you're planning on some kitchen upgrades or some equipment upgrades in the next 3 or 4 months, and this is a high tax year for you, you've had a really good year, you have higher taxable income, you might want to accelerate some of those purchases before year end to take advantage of that write-off in the current year. Again, a discussion to have with your tax advisor. Take this to him or her uh, quickly here before year end while they have time to consider it and while you have time to make a move before year end. Permanent QBI, qualified business income deduction, also known as the small business income deduction, with better thresholds. It's now permanent. That 20% QBI, qualified business income deduction, is not going to be phased out unless there's some major changes through Congress once there might be a regime change there in Congress. Key changes are the deduction is permanent. There are higher income thresholds to take advantage of the deduction, 395,000 for joint filers. Most restaurant owners now qualify for the full benefit. Example savings, you're a restaurant with 200,000 in QBI, qualified business income from your business that's flowing through to you on your personal return, either because you're an S Corp, you're an LLC, or a Schedule C, which is, I wouldn't advise. You can now deduct $40,000 from your taxable income for a potential savings of $8,800 in taxes, assuming a 22% tax bracket. These things add up. That $8,000 reduction in taxes is money that you can use inside your restaurant to improve marketing, to improve processes, to improve your equipment. So those are things that you need to make sure that your tax advisor is taking advantage of on your behalf. No tax on tips, something that you need to be very aware of. This is new with the One Big Beautiful Bill Act. It's temporary through 2028, but there's probably a good chance it'll be extended. Once these benefits are given to a worker class like restaurant servers or kitchen staff, it's hard for Congress to take those away without a negative political impact. So what's covered? Workers earning under 150,000 can deduct up to $25,000 in tips income or overtime pay. This applies to servers, bartenders, bussers, anybody on your payroll that's tipped, or anybody on your payroll that is given time and a half for overtime pay. It includes overtime pay for all restaurant staff. The deduction is taken on the employee's personal tax return. So it's on their individual tax return on an annual basis that deduction is calculated. Make sure they're aware of this and make sure that they take this to whoever's preparing their tax return to make sure they're taking advantage of it. The business impact for you is that their take-home pay really kind of increases because of this once a year during tax time without changing your payroll costs. You want to make sure they're aware of it and that they take advantage of it. So the employer W-2 reporting requirements, for you, it's reporting on the W-2 what their overtime pay is and what their tips are. Now, tips have already been reported on their W-2, but you might have to implement some procedures to make sure that on the W-2, all your tracking for overtime pay for the entire year is reported. Those changes will be made with this year's W-2s. And this improves retention and reduced turnover. Theoretically, there's nothing that you've done on your behalf to improve their net income results, but just making them aware might increase their overall satisfaction with the type of job that they have and lead to higher morale and staff satisfaction. All right, moving on. Enhanced deductions for employee benefits. Now, these are, some of you might be thinking that my payroll expenses are high enough the way as it is. I'm not going to offer these benefits to my employees because I can barely afford to keep them on the way it is. Well, if you're looking at ways to retain your key employees, your shift managers, your executive chef, your front of house manager. These are some things that you might consider because they are a deduction for you as the employer. So, student loan repayment, tax-free benefit for your employees with student debt. You can contribute up to 5,250 annually without increasing their taxable income, and it is a deduction for you, the employer, on your business tax return. Boosted child care credits, increased tax credits for employer-provided child care assistance, helping restaurant workers with families manage challenging schedules. Now, all of these you need to discuss with your tax advisor to make sure that you have the programs in place to appropriately document it and appropriately manage it so you do get the legal deduction. Paid family leave credits, tax credits for restaurants offering paid family and medical leave to employees, offsetting a significant portion of the cost. So these benefits only reduce your tax burden, but become powerful recruiting and retention tools for your staff in a competitive labor market. Something to consider. It's not free. It does require cash flow out of your business, cash flow cycle, but it would be something to consider if you're trying to increase your ability to retain key employees. Some additional benefits for restaurant owners, the SALT deduction. That's your sales and real estate tax deduction on your individual tax return. You can now deduct up to $40,000 in state and local taxes, including real estate taxes. It's temporary through 2029. That's a big increase from the 10,000 cap that was there. So it could impact your bottom line taxes, particularly in high tax states like California, New York, and Illinois. R&D expenses, immediate deduction for domestic research and development activities. Now, this is for customized R&D, new point of sale systems, customized implementations, custom software development that has been developed just for you in your business and is particular to your business. We're not talking about off-the-shelf software. Custom menu data analytics tools, operational workflow improvements, all these things could qualify. It's a complex area. If you feel like you're doing anything and spending money in any of these areas, be sure to bring up R&D expensing and credits with your tax preparer. So restaurant relative tax provisions at a glance. 100% bonus depreciation. The key benefit is instant write-offs on equipment. Make sure you're considering the timing on those write-offs, especially right now before year end. Enhanced Section 179. That's larger immediate deductions for qualifying assets like kitchen equipment. Permanent QBI deduction, qualified business deduction, the so-called small business deduction. Sustained 20% deduction for higher eligibility thresholds. It's no longer going to be phased out. Tip and overtime relief. Make sure your employees are aware of it. Reducing turnover and improving morale. Employee benefit credits, tax efficient programs like student loans and childcare to attract and retain staff, R&D expensing, immediate write-off on innovation costs for retroactively, even retroactive for tech investments. The one thing that I see is missing here from my list is considering those tax credits, work opportunity tax credit, and the FICA tax tips credit. Make sure those are being taken advantage on your business and personal tax returns. So some forward-thinking moves. Don't wait to act. Accelerate equipment purchases. We talked about if you're planning some equipment purchases in the next 3 or 4, 5, 6 months, consider accelerating those purchases into the current year if that's appropriate inside of your tax planning. Review your entity structure. Make sure you're set up correctly as an entity to take advantage at the individual income tax return level with the correct entity tax return. It provides more advantages for tax savings at the individual level. Update your payroll systems to make sure that you're tracking your tips. That's something that should already be in place, and tracking your overtime pay as well, so that your employees can take advantage of those tax reductions. And then implementing new benefit programs, some of them that we talked about were student loan assistance or enhanced child care benefits. If it makes sense to you in your cash flow planning to implement some of those benefit programs to increase your advantage for retaining and attracting key employees. Implementation roadmap. Successful tax planning requires structured approach, quarterly meetings with your tax professional, real-time bookkeeping systems, which is something that we provide our independently owned restaurants at Financial Optics, and robust documentation processes. Don't just work hard, keep more of what you earn. Book a free profits and cash flow analysis initial meeting with me. I love talking to individual restaurant owners, independent restaurant owners. Schedule a no obligation review of we'll look at your current accounting systems and processes. We'll even analyze your recent financial results in your restaurant to come up with possible tax deductions and then some overall financial performance, and identify some big opportunities that you might be able to take advantage of in your restaurant to map a path to more profit and cash flow. I'll leave a link in the comments below this recording on Facebook Live that will provide a link to my calendar. I would love to talk to you. We'll look forward to talking to you, and we'll talk to you next week. Have a great week. See you next week.